In this video, traders, we're going to look at, is having a wider stop the silver bullet for your trading? Stay tuned. Hey guys, warm welcome to you. All right, so I was having a discussion with another trader. He's pretty new to the business. He's been trading kind of 6 months to a year, I think it is. But he's one of those guys who gets it. You know, he's asking the right questions. He's kind of learning, and he seems to be really growing kind of every time I chat to this guy. And one of the things that we were talking about with other groups of traders, and one of the things that he mentioned, is often when he has a wider stop that he ends up staying in the trade. Now that might seem obvious, because if you widen your stop, the probability of it being tagged reduces dramatically. And so if you've got to kind of think about it, if you want to go to extremes, 1,000 pip stop, what's the chance of that being hit in the next 5 days? Pretty slim. 10 pip stop, pretty high. So yes, we get that, but the point he was making, and this is something that I want to touch on two things here, is that there is a sweet spot between being stopped out constantly by having your stop too tight and having it too wide. And we've talked about this before in terms of, hey, we want to have our stop where we've got noise. We want to be just outside this noise. So we don't want to be in an area where we're going to get stopped out and the trade is still valid. And one of the examples we were talking about was, let's say you're trading a kind of support level here. Many times, you know, one of the better trades that I like to take, and I've kind of shared this with you guys before, is one where we dip under, put a little wick in. Imagine this is a candle actually rather than a bar. I prefer to visualize it that way. Dip under, comes back up. I'll take those all every day because I can quantify my risk under that low. Now, many people will take the trade here and end up putting their stop under that support. But of course, that really brings you into the noise area as opposed to being outside of the noise area. So you either wait for the wick or you give yourself a little bit of room and say, what's the wick likely to be? Okay, maybe the width of the candle. Let me put my stop there. Anyway, we're digressing slightly. Going back to the point, is it the silver bullet? So there's two things to look at here. Trying a wider stop. So there's the actual operational perspective of getting better returns, because you have a wider stop, you may well kind of be in trades that would have stopped you out otherwise. And there's another thing as well, guys, is that, in fact, there's two more things. You can get super frustrated if you're getting stopped out all the time, right? That death by 1,000 cuts. Been there, done it, it hurts. You feel like you've got the right stop, you're getting stopped, the market goes off in your direction, you get stopped again, the market goes off in your direction, and you feel like, hang on a second, and the frustration that you get from that often overwhelms the logic of, well, why didn't I just move my stop? And I've talked about a story about me trading down and having to move my stop a little bit wider. It kind of fixed a lot of things. But there's two things to continue on now. The main thing of this, guys, is that if you are going to widen your stop, the benefit of this is, yes, you may get stopped out. And if you look at this as an exercise of gathering data, so you've got your strategy, maybe it's not working, whatever it is, doesn't matter. You widen your stop, you're going to get stopped out from time to time. It may not be profitable over that period of time that you're doing it, say 30 days, 45 days, or whatever it may be. The point is, you are going to have excellent data that says, hey, look, I can now, if I have my stop at this level, you can literally go back and say, right, if I had my stop at this level on all these trades, how would I have fared? And more than likely, you will find the sweet spot between having it wide. Let's use some numbers here. Let's say you use a 15 pip stop, for example, and now let's say you go to a 40 pip stop. And some people might be like, oh, that's a bit wide. The point is, if you're doing it for kind of 30 to 45 days, yes, you may get stopped out. But if you look at it from a mathematical perspective, you shouldn't get stopped out more. Well, you're not going to get stopped out more, but the times of stopping out should be equal themselves out in terms of loss, because of probability of touch and all that kind of stuff. So the point of this is, then you now get some information and you say, right, over my trades, I had some really good trades, and that's a perfect one. Sometimes I got stopped out when I shouldn't have been stopped out and I gave too much back. So where's the sweet spot for the current market conditions? Where do I need to kind of bring my stop? If you're getting stopped out constantly, it's not 15. And if this 40 pips is really too much risk and you're kind of hitting 4 or 5 stop losses, however many trades you're taking, and it's giving negative expectancy, and that's too wide. Now, it may be there's an underlying problem, the strategy is wrong, but doing this by widening that stop highlights the issue of your strategy. It could be something to do with the stop loss, in which case that will highlight it. You can adjust it and go, actually, you know what, 22 would be perfect in those conditions. Let's roll the 25 pip stop. Let's adjust the position size to suit, and let's just adjust potential targets and try and adapt the strategy around that framework. It could be that this doesn't solve anything and you're just not getting the entries right at all. You're just reading the market wrong. You're trying to buy when it's in a weak market, or whatever it may be, you're just not hitting it right. In which case, great, you've got superb information that you can say, right, well, it's nothing to do with my stops. It's nothing to do with me being pinged out all the time. I'm just not good at hitting it. For whatever reason, this strategy is not working, and let's go back to the drawing board and start it again. So we've got two things here, just recapping, guys. We've got the first thing, which is really making sure that the psychology aspect of being stopped all the time is so frustrating, is removing that by widening the stop. And the second point is getting the data that we can then use to push back into our strategy. So not only from a strategy effectiveness perspective, but also from a stop position perspective. So my kind of idea on this is, if there's a strategy that's not quite working, I've done this frequently, guys, I've talked about this before, and I've done a whole video about this before. If this strategy is not working for you, or if your whole trading is just not working for you, make sure you split up in strategies as the first port of call, but then widen the stop out. Widen the stop and say, and just see what happens. Reduce that position size, look at it as an exercise of not trying to make money, but it's trying to identify where the issue is. Because the trouble is, if you're getting stopped out all the time, let's say using that 15 pip stop and you're getting pinged, 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 pinged. Yes, we talked about how frustrating that is and reducing the confidence and all the other things that come with that. But the second thing is, you never get a chance to identify a good strategy. You could have the best strategy in the world, and it could literally be 16 pips makes that into a profitable expectancy strategy over the time you've taken it, and you won't know that because you're so caught up in the fact that you're getting stopped out and getting the death by 1,000 cuts syndrome. So widen it out, see what you get, see the results you get, review it, come back, then you can make changes and make assessments. We don't need to be kind of, you know, scrubbing everything off and starting again and getting all frustrated. Very often we've got something there that's working and needs to be adapted. Now, final thing, guys, you may find that it's just not suitable. You might find that the stop is so wide, the targets aren't that wide, aren't that far, so your risk reward ratio is skewed, because, you know, there is a caveat to this. If you start doing that, your risk reward ratio starts to get compressed, which is not what we want. But the thing to point out then is that may not be the strategy for the market conditions, or it may not be the right market for your style and strategy and stuff, but it's a good starting point, guys. So having a wider stop may be the silver bullet. Check it out, have a think about that. Let me know your thoughts in the comments section below. And as always, keep your risk managed, and I will see you guys in the next video. Take care. Bye-bye.